Everybody, it's Mark Pruitt with Strategic Estate Planning Services here for another strategic market update. I hope this video finds you well. I wanted to set and give you some basic information that has now come down the pipe we've been waiting on after the first quarter of 2022. I'm going to give you the link that will be in this update as well. You can go through there and research this and read the articles for yourself. You could probably go all over the internet and find this stuff anyway because it's a big topic now that it's been given. We predicted ourselves that the first quarter would be either barely positive or actually I think I said flat or negative. What we didn't realize is it was going to be to the degree that it was, even more so. And I think economists, in fact I'm going to give you an economist here, a Harvard economist, who's a former IMF chief economist, Ken Rogoff, says that he feels like their recession is a 50-50 chance over the next year. Recessions are called once you see 6 months or 2 quarters of negative GDP. We have just gone through January, February, and March, and that number was a shocking minus 1.4%. in GDP. So that was a negative quarter. That's our first negative quarter. I feel like personally that we'll probably have another negative quarter this coming quarter as well. Things are continuing to contract. We don't know that yet, but that's what we felt all along. And I think a recession potentially could be before the end of this year. And I can tell you, based on some of the information that has been given, Powell has already confirmed, Jerome Powell, the head of the Federal Reserve, has already confirmed that there's an expectation, and he solidified this for a 0.5 point rate hike at the central bank's May meeting, which is, again, so you see things such as GDP shrinking, you see interest rates going up, and you see the Federal Reserve is now saying that they're going to begin to stop buying Treasury notes. And it's interesting to see Treasury notes that have come into the market and the economy has still shrunk, even though that has occurred. And so now they're saying that those are going to begin to stop. They're going to raise interest rates. And so we've said all along, we felt like May is the month that you've got to kind of hang on because it's going to be several things that will kick in. I can also tell you, you can look at the 10-year Treasury note. We track it every day. You can track it on Yahoo Finance as an example. It's easy to see. That is still higher than it should be. What normally happens is when people begin to come out of markets, they run to bonds. And when you do that, that can dilute that 10-year Treasury note. So we'll see. We're expecting that to occur as people begin to come out of markets. Right now, markets are we see, I don't have to tell you, you see it every day. They're down 600 points and they're up 600 points. As of this filming today, it was down right at 20%. When you see the Russell down over 15%, you see the Dow down over 10%. You can see this every day, and you can see, okay, how's that going in regards to our own portfolio? So we're doing our best as we can to not mirror that market, but we're also waiting that we know as the markets get tighter that people will come out of markets and they will run to bonds, and we're positioned for that now. So we're kind of already there in some long positions to where we're ready to go. It's just a matter of getting through this in May, which is when we thought it was going to be coming, right in the middle of the second quarter. So kind of keep that in mind. I just wanted to touch base with you and let you know that the first quarter's out, the numbers are in, is a minus 1.4% in GDP. So that's not a good sign. We see the markets are contracting. If you look and do some history on your own, I can tell you that they only usually work on getting rid of inflation one of 2 ways. They either raise interest rates, and they continue to raise interest rates, and sometimes to the point of raising it and creating recessions. Because as interest rates get higher, people don't want to spend as much. They don't want to take that cheap money. Now that money's costing them more. And so they don't want to go into debt as much as they used to because the money is at a higher rate. And that causes things to begin to contract. And that's exactly what's happening right now. So we'll see. It's going to be interesting to see how the rest of this particular year goes. But they've got to get inflation under control, and it's either going to be through recession or it's going to be through interest rate hikes. That's what history has always shown us. It's easy to find that and track that as well. Hopefully this has been helpful for you. It's a short one, but I wanted to kind of give you the number for the first quarter GDP, which is down. And so we'll see what the second quarter gives us, and then we'll be positioned and ready as always. If you have any questions at all, please feel free to call any of us here at the office. We'll be more than happy to help you. And the other thing is to remember, I still continue to say the same thing and remind you, is that you still have, if you are in annuities, you don't have to worry about those assets. They are fixed assets that do not have market wobble in them, market trends of going up and down. They're solid, they're your floor, they're a good base, and that's exactly why we have them, to provide that safety net for our clients. Thank you guys for being here. Hope you're doing well. Have a great rest of the week. God bless each one of you.